uh, our presentation will fill the full window today, so yeah, we can go ahead and get started. So thanks, Terry. I want to welcome everyone to our monthly chapter meeting. My name's Matt Marion. I'm with BKD CPAs and Advisors, and also currently serve as our chapter president. Want to take a moment to welcome everybody to our event today. Typically, we try to host this event in the spring, and unfortunately, with COVID, we bumped out to the fall in hopes we would be able to do this in person. Unfortunately, that's still not the case, but I think it's great to still in a virtual event be able to honor some significant deals in the area from the past year. Before we start, I want to take a moment to highlight our sponsors. Without them, a lot of the programming that we do would not be possible. Definitely want to highlight for this, especially our event sponsor, Frost Brown Todd. They're a longtime sponsor of the chapter, and they did a lot of the heavy lifting, the background to make this event possible. So definitely want to highlight them. Also want to highlight both our annual chapter sponsors, which are included here, as well as our corporate, virtual table sponsors. A lot of these groups have been longtime supporters of the chapter, and as I mentioned, make a lot of the programming we have possible. Also want to highlight quickly upcoming events. This is the rest of our fall calendar. We'll talk a little more about the November meeting at the tail end, but we'll have Middle Ground Capital, which is a group based out of Lexington, a private equity group that'll be with us next month. And then also on the upcoming calendar, December will be our annual co-hosted event with FEI and ACG. Additional details and date to follow on that, but just something we wanted to get on everybody's radar. Also, we don't have a slide for it, but just a quick mention for membership. I know for those who are guests at our event today, encourage membership in our chapter, both from access to programming, but also some of the social events we do and the networking opportunities it presents. Additional info on that, feel free to reach out to myself or Terry McWilliams, our chapter administrator, and we're happy to talk to you more about membership or sponsorship and provide additional details there. And then one quick housekeeping item before I turn things over to Bill. At the end of our presentation today, we will be doing a moderated Q&A. So what we encourage is that as things go along, if you have questions, please just enter them in the chat bar, and then we'll use them as a pool for driving that moderated Q&A at the tail end. So right now, I'll turn things over to our Master of Ceremonies. Bill Strench is a partner with Frost Brown Todd. Handled a lot of the background info on making things possible here today, and an executive committee member for the chapter here for a long time as well. So, Bill, I'll turn things over to you.
Thanks, Matt. The deal of the year is now in its 5th year. It's unique in Kentucky in that the event focuses on deals, not companies, not individuals. As such, it's aligned with ACG's focus on corporate growth. Honorees were selected from transactions through research and from a pool of candidate transactions that were solicited from and nominated by the regional business community. The transactions had to close in calendar year 2019. Those which closed before or after were not reviewed. A 4-person committee comprised of veteran deal makers reviewed nearly 60 qualifying transactions and selected the winner and finalists based on the transactions best fulfilling the evaluation criteria weighted by the judges. The judges looked at these areas. 1, location. The principal office, the headquarters, or substantial operations, are they local? Transaction impact on the local communities, such as job growth. Focus on local investment, finance, and private equity. The extent the transaction was transformative for the local company. And then quantitative metrics, dollar value of the deal, financial impact on the parties involved, number of employees, and other operational metrics. The 4 judges were Ken Berryman, who's with Weller Equity, John Sweeney from Baird, Alan McDonald from Frost Brown Todd, and Brad Smith from MCM. We will announce the winners and the finalists, and we'll have the executives from each of these honored companies who will talk about the strategies and benefits from the deals. But first, I'd like to introduce John Sweeney from Baird. He will be presenting an overview of the current M&A landscape. John?
Great, thanks, Bill. One of the bigger deals of 2019 that did not make it into the listing here because it sort of closed in one year and out the other, and also, unfortunately, it was the owner of the final finalist of that ended up was out of Milwaukee, not Kentucky, and that was Baird purchasing my old company, Hilliard Lyons LLC, and as a result, I am now a Baird employee and with Baird Business Owner Solutions. And just to give you a quick commercial on us, we're doing exactly the same thing we used to do, which is sort of lower middle market investment banking. Our focus is sort of in that, call it 3 million to 20 million in EBITDA size range. For the most part, we are working on tip of the spear type activity. So first sellers to both the private capital markets and to strategic buyers, doing a lot of education and et cetera, as we always have done. Again, still an outstanding market for sellers, as you will see as we sort of go through this particular presentation. Let me just pull this up. So just to kind of give you an overview of the robust M&A is continuing. We've had a little bit of a drop off year simply because of COVID, as you might expect. The actual deal flow here will probably rise up quite a bit more than what you're seeing on this chart because much of the deals have been pushed to the end of the year. And what we're seeing now is sort of a barbell type thing where quite a few deals closed in the first quarter, not practically zero in the second quarter and fewer in the third, and most of them will be pushed to the fourth quarter. So we'll see quite a bit of sort of closings, both from opportunistic sales and also from sellers that are somewhat concerned about how the election might turn out and how the capital gains effect might impinge on total value in 2021 should Joe Biden have his agenda put forth. Going on to the next page here. Hold on, let me just sorry. Talking about private equity capital availability, the biggest sort of takeout of this particular chart would be that there is an immense amount of capital available on the private equity side, as there always has been. But 2019 was a record year, especially for middle market. There was approximately 134 raised in 2019 from 149 separate middle market funds. And, that's an average of just about 900 million per fund. So as you might imagine, the amount of liquidity out there that was ready to go for 2020 is still much of it pending. So valuations for quality companies have been really held up here. There's been somewhat of what we call sort of a COVID gift in that much of the COVID impact is sort of taken for granted since it affected everybody, and it's being incorporated into valuations and not really having much effect on valuations as a result, especially for quality companies, some of which have benefited from the aspect of the DTC formulas that they're pushing forward. Going forward to the next page, Marcy, if you could. So this is you guys have seen this page before. We do it pretty much every year, and we have not changed much. I would say that, as you can see on the higher ends, the multiples continue to increase, especially sort of in the 50+ million range. So if you have something in that department, you're really you're sitting in the catbird seat. There's a number of funds that have been formed that are really looking for that sort of select deal, sort of between the $50 and the $250 million range. I would say that that's one of the most robust areas of activity right now. As you can see from the chart, your valuations here for this particular page are taking into effect the enterprise value of a company, starting in the $10 to $25 million range at the very bottom, where, in quarter 2020, that number has really not moved since 2000 and call it 6 or 7. It's about 6 times, frankly, and that it's dropped just a little bit in quarter 2 2020, but really 6 times is kind of the average range. So you can expect, again, a 5 to 7 sort of an average range in your enterprise value for companies that are valued between 10 and 25. 25 to 50, you can add another turn on top of that. So we're talking close to a 7 times average. Again, take that, it's the middle of the range. So 6 to 8. In the $50 to $100 million range, you start to see a little bit of an acceleration. You add a turn and a half to 8.5 times in quarter 2 2020. And again, this is somewhat reflective of the quality of the companies that are being sold this year, more so really than probably average. So you're seeing above average pricing, but you're also seeing above average companies being sold. The companies that are not being sold, obviously, are the ones that are not being incorporated into the math here. Again, 100 to 250 million is really the top of your range, and at 9.5 times, that again is a midpoint. So really, double digit is what we would expect for anything that we would value over 100 million would be a double digit multiple in almost. And this is across a broad spectrum. This is all just lower middle market companies, 250 million and below. So in this, you'll have things that are going to be lower valued with regard to heavier capital intensive companies, to those that are SaaS type vehicles that have recurring revenues and very little overhead, and those would be your higher multiples. Some of those are approaching mid-teens at this point in valuation range. Marcy, if you go on to the next page. Okay, so this right here, this is just sort of an agglomeration. I know you can't really see this that well, so I'll just talk very quickly through it. This is kind of the announced transactions for the year in what we consider to be the middle market, and the source is Capital IQ. This year is kind of interesting because in 2019 we didn't have any, at least announced deals over 500 million. Usually we have 1 or 2 that are in the $1 billion range. This past 2019 we didn't have anything. And we didn't have anything over 500 either. We had 4 deals over, between the range of 100 to 500, and then we had less than 100 million was 21 transactions, and of course these are all announced numbers. So some of them, are just not going to show up because 96 of the transactions that we've talked about to make the total are not disclosed at all, and so we don't have actual numbers for those particular transactions. The breakout as far as sectors were being bought and sold. We had none in the energy space this year, which is unusual for a coal-oriented state, a natural resource-oriented state. 3 real estate transactions announced, 6 in the building area, 27 in the industrials, and 26 in the consumer discretionary, which is exactly the way we would expect, given our sort of Midwest manufacturing base. Consumer staples, we had 4, 17 in healthcare, which is pretty typical as well, 16 in financials, and that would include most of the bank transactions that occur every year in, year out. And information technology, only 9. So we only had 9 tech deals in the region last year, which is something that maybe we need to work on. And 5 in the communication services arena as well, which is sort of a blend over on the tech side. Going back to the next page, Marcy, this is just the major transactions, and we have our 3 finalists at the top. D.D. Williamson's acquisition of DuPont, Natural Colors, Pernod Ricard's purchase of Rabbit Hole Spirits, and Acumen's purchase of 3DR here in town. The transactions are listed here. We only listed the ones that have actual numbers attached to them. We thought that might be of some interest. Biggest of those is United States Playing Card Company, which sold.
Switching slides now. So.
Sorry, I'm looking at my page, not yours. I'm not sure what's up. Are we having trouble getting the next page? Okay. Hoping people can see a little bit of this. We tried to make it as big as possible. The seller of the United States Playing Card Company this time around was Newell Brands. That company has been sold multiple times by private equity, and Newell eventually bought it. They sold it to Cartamundi, which is a foreign company. That company has been sold multiple times up in the Cincinnati sort of region up there, top of northern Kentucky. First Financial bought HopFed Corp, which some of you may be familiar with that deal. $135 million is probably the largest bank deal that was completed last year. Stanley Black & Decker sold Sargent & Greenleaf to OpenGate, which is a private equity concern. German American bought Citizens First out of Bowling Green. First Bank Financial Corp. Bought FNB Financial out of Scottsville. Hard Rock Cafe, which is a casino, sold Turfway Park, which has kind of been interesting. Getting out of the race business. Victory Bank Corp bought Victory Community Bank from. Heartland Bank bought from Victory Bank Corp the Victory Community Bank. Gould's Discount here in town, which many of you are probably familiar with if you're sort of down there in the Dutchman's Lane area, sold finally to Adapt Health Corp, which is a publicly traded company. Sort of going down, just looking at Laguna Development also sold was purchased Ellis Park Racecourse, another Saratoga casino sale, which sort of interesting that these casinos, which had gotten into the race business, I think maybe for the one-armed bandit business, have decided to exit the race business. So that may be indicative for what we're looking at here in Kentucky. Last one I would probably point out here is CRH Medical Corp buying Anesthesia Care. Specialty doctor practices have continued to be very popular sellers and buyers in the M&A market. So something to keep an eye out for is a lot of these physicians out there today are throwing up their hands with regard to the administrative costs that they're having to deal with, bureaucracy, and they're looking for a safe home. And a lot of them are getting, especially if they're in a specialty arena, are getting some pretty decent valuations. So something to think about on the sort of deal business side. And I guess I am now turning it back over to our esteemed MC, Bill Strench, who will announce the finalists and introduce them for their part of the section.
Thank you, John. And as you can see from John's presentation, there was a lot of competition this year, which made the judging very, very difficult to do, to come down to 3 finalists. So I'll start with our first finalist, which is 3DR, which is a 3DR scanning imaging company that was acquired by Acumen out of Phoenix, Arizona. And Acumen is a healthcare consulting and services company. 3DR was co-founded by Rob Falk, who's a radiologist in Louisville. And Dave Ferguson was an early investor in the company and was brought in shortly after the company got started as CEO of the company. And between the two, Dr. Falk and Dave Ferguson grew the company over a sustained period of time. And the growth was rapid, but it was also amazingly steady over this period of time. And the end result of this was the acquisition by Acumen. So I'm pleased to introduce Dave Ferguson, who will take it from there.
Great. Thank you, Bill. I appreciate it. I'm going to briefly go through a little bit about what 3DR is. We are what's called a managed outsourced service for hospitals, teleradiology firms, and basically standalone imaging centers. We do not interpret things, the pictures that we produce, but what we do is we take the scans that produce two-dimensional images, either CT scans, MRI scans. I'm sure all of you have had either a CT or an MRI, and those produce two-dimensional images that can be worked on through what we call post-processing to create the images you see above. So you might look at the left, these are before they have been post-processed, and the ones on the right are much more, they're three-dimensional images. They are very, very useful, especially to the radiologist and to the referring physicians. We do this remotely. We have over 900 hospitals and other clients around the United States. We're the largest firm like this in the United States. And to make a long story short, the images are sent to us across secure internet linkages, and we then take those images, we then categorize them, we put them into our own workflow system, which I'll talk a little bit about later on, and send back the finished images to go to the radiologist or the referring physicians. Can you hit the next thing? The reason people use us is for a bunch of reasons. Any of these hospitals could create their own 3D lab, but it is basically the reimbursements that are available for doing this kind of post-processing, even though there's a lot of quality and value associated with it, don't really justify an individual hospital doing it. So basically, we can provide quality 24/7 services at a fairly low price per case, and free up their own in-house radiologic technologists to do this. And so that's basically the story that we brought to the market in 2005, and we were an overnight success 14 years later. We'll talk a little bit about, I'll show you some graphs here in just a few minutes. Next slide, please. These are some of the key things that happened from 2007 after we really got started with the company. We got most of our initial capital from local angel investors. All total, over a period of between 2007 and 2011, we had raised about $5 million from local angels. And finally, we got one public-private investment bank to put a substantial chunk in around 2012. With that, we were able to pay off all of our debt, and we never looked back. We've been profitable ever since. At one point, we were paying some debt service that was really not very affordable for us. You can see from 2007 to 2019, we were able to attract some of the largest names in the country, from Centera to Adventist to Scripps to Carl to HCA to the Baptist system. You can keep naming the names of hospital systems that are well known in the United States. But you can also see that we broke even at about 5,000 cases per month. A case is one set of images that are sent to us that we then post-process. In the first cases we performed were really in the fall of spring of 2007. We did that month in January 35 cases. This past month we did 30,000 cases, all from here in Louisville, Kentucky. Next image, please. This table kind of, it's busy and it summarizes a lot, but to show you what we were able to accomplish from 2016 on, we had from those years, including this year, in spite of COVID, we've been able to achieve a 30% compounded growth in terms of number of cases. And if you look on the right side, you see the corresponding revenue and EBITDA that came from that. So we're pretty proud of those accomplishments, and I think that was one of the reasons why we were able to attract a really good purchaser. Like I said earlier, we're the largest medical image post-processing lab in the United States. There are only a couple of competitors, and they are way behind us. We have a strong customer base that's growing with a market that is very large. We have over 6,000 hospitals and imaging centers that we can market to. I mentioned 30% earlier. We have our own proprietary technology that lets us move the data quickly and securely, because we certainly are very instrumental about, or very serious about HIPAA and making sure that we don't do anything stupid like send data to the wrong place. And we have a veteran management team that's been with me from the very beginning. In fact, a couple of the folks, this is our fourth startup company we've done since the late 80s. Next case, please. Next image. This is a map that shows the distribution of where our clients are. Like I said, we have over 900 individual facilities that send us cases, and we have 160 employees, almost all of whom work here in Louisville. You've asked, how did we handle COVID? Very well. We had about 6 weeks of reduced volume, and then all of a sudden, when they went back to voluntary, allowing the hospitals to come back with voluntary pay, everybody working from home were able to really continue to work, and we've hired 30 more people since then. And we're looking probably in the next year of hiring another 40 to 50. We train all of the people we hire. It's about a 3-month training process. They are all certified rad techs. And of course, with Dr. Falk and his team, because I'm definitely not a radiologist, I'm more of a financial guy and a computer systems engineer. But we're very pleased with the fact we weathered COVID pretty well. The last chart, and then I'll go to the next person, is a summary of Arsenal Healthcare. Arsenal is a private equity firm I had never heard of, but they made their bones in perfecting or increasing the productivity of health-oriented laboratories, especially blood labs and tissue labs, and they wanted to increase their breadth. So they bought us last year, and they bought another company called Halfpenny, which does HL7 medical record interfacing. So the three of us together, we have the laboratories, we have the radiology groups that we work with, and now we're working on the medical record groups. I will hush with that. I think I'm within my 5 minutes, and look forward to any questions you may have.
We will go on to our next finalist, which is Rabbit Hole Distillery. ACG is recognizing Rabbit Hole Distillery for the transaction that strengthened its position in the industry. In 2019, Pernod Ricard became partners with Rabbit Hole, adding its portfolio of brands, which include Absolute Vodka, Chivas Regal, Jameson Irish Whiskey, and Beefeater Gin, among others. Accepting the award today is Kaveh Zamanian, the founder of Rabbit Hole. Kaveh left his 20-year psychology practice in 2012 to create the company and pursue a dream of bourbon and whiskey creativity, building a distillery from scratch on Jefferson Street in Louisville. I'm pleased to introduce Kaveh.
Thank you, everyone. It's truly my deep gratitude and appreciation to ACG Kentucky. It's an absolute honor to be a finalist for Deal of the Year award, along with the other nominees and the other spectacular deals that we're considered for this year. I'm truly proud to be here. You know, Rabbit Hole started with an ambitious goal to become the next big American whiskey company out of Kentucky. It was founded on the basic idea that by simply bringing traditional and modern approaches, we can innovate and ultimately elevate American whiskey and bourbon to its rightful place along with other national spirits around the world. There's a belief in Kentucky that somehow the industry has not moved much from a standpoint of innovation, but I think the craft distilling movement in the last few years, and particularly what Rabbit Hole has done, shows that not only innovation is a key factor to our success, but it's something that is going to be part of success in the future to come for Rabbit Hole and many other brands in our industry. With the support of our local investment community, I was able to launch Rabbit Hole, and with my capable team, catapulted to a position of success and notoriety to help us secure a partnership last year with the second largest spirit company in the world. I truly believe the key to our success was our values of authenticity, transparency, innovation, and distinction. These are values that are embodied by our distillery in the heart of Louisville. In fact, if you go to the next couple of slides, you will see essentially, what I'm talking about in terms of the glass and steel structure that really embodied that transparency that's part and parcel of our DNA. You can go to the next slide if you like, the next couple of slides. There you go. Our production capacity of nearly 22,000 barrels a year has placed the distillery now as the 16th largest bourbon producer in the world. The glass and steel structure has been now named the architectural icon of the Kentucky Bourbon Trail. But most importantly, if you want to go to the next slide, actually a couple of ones after that, these are just a few images of the distillery. Thank you. But most importantly, it was our award-winning spirits that got the attention of all the major spirit companies from around the world. It was pretty staggering, frankly, that we ended up getting calls from essentially all the major players in a relatively short period of time. Ultimately, it was my desire to scale the company, to see it become the next big American whiskey brand in my lifetime, along with shared values, vision, and cultural alignment, prompted us to choose Paris-based Pernod Ricard as our partner. If you want to just go on to the next slide, the next couple of slides. This slide is basically showing our tasting room at the distillery on Jefferson, between Jefferson and Market. And if you want to go to the next one, this was actually an open letter that myself and Pernod's CEO, Alex Ricard, wrote announcing our partnership. In the past year since this partnership with Pernod, in spite of challenges with COVID and all the social unrest, as well as domestic and global economic uncertainty, in particular with tariffs, global tariffs, and things of that nature, Rabbit Hole, in spite of all that, is growing and expanding at a phenomenal rate. It's been a pretty incredible year for us. We're now one of the fastest growing whiskey brands in the country and are about to open several international markets. So from my perspective, Rabbit Hole's future is quite promising. And I think this partnership has really allowed us to have the financial wherewithal and security to be able to scale the business in a truly meaningful way. Now, in addition to the distillery, we have started development of our maturation aging campus in Campbellsburg, Kentucky, and have established a long-term vision for that site. What you saw at the last slide and this one, and you can go to this one. These are all kind of highlighting our plans for Campbellsburg. We've just about finished our second warehouse. We're starting our third warehouse. We're on a cadence of at least 1 to 2 warehouses a year for the next 5 years. And what you're seeing on this slide is actually our plans that were finalized for a visitor center in Henry County. Of course, COVID has put a dent in that project, but it's on hold at this point, waiting to see what happens with the hospitality kind of tourism, in some ways, state of affairs. But long and short of it is that my goal is to ensure now with this partnership for Rabbit Hole to become the operational hub and center of excellence for Pernod Ricard in the U.S. Pernod actually does not have a quote unquote brand home, if you would, and an operational center in the U.S. And our goal is to essentially become that here in Louisville. This goal is truly out of deep love and affection for Louisville and Kentucky, and my way to ensure that Rabbit Hole is an engine for economic growth and development in Louisville and in Kentucky. Ultimately, I believe that Rabbit Hole is a dream that has become a reality with the help of community support, community investment, a lot of local believers who recognize that if you build it, they will truly come. And again, I really appreciate you guys taking the time and nominating us. We're very proud and privileged to be here. Thank you.
Thank you, Kaveh. And now we'll move to the winner of Deal of the Year for 2020. And the winner goes to D.D. Williamson and Company for its June 2019 acquisition of the natural color business from DuPont. If you don't know anything about D.D. Williamson, it's Louisville's not so hidden secret. It's a locally based, privately held company providing natural color solutions for the global food and beverage industry. It has 13 manufacturing and sales locations on 5 continents. Accepting the award is Ted Nixon, who's the chairman and CEO of D.D. Williamson. Ted joined D.D. Williamson in 1974, became director of operations in 76, president and CEO in 1982, COO in 1982, and CEO in 1992. And he has a long history of philanthropic work in Louisville. He led the 2019 acquisition of the natural colors business from DuPont. I'm pleased to introduce Ted.
There we go. Thanks, Phil and Terry and Matt and the rest of the group for nominating and voting on DDW. As Bill mentioned, we're sort of an unsung company in Louisville, and I guess it was publicly in the paper, but it isn't something that we necessarily talk about. So first of all, a little bit about D.D. Williamson, since we maybe aren't, is we are privately held. Our global support center and 2 of our manufacturing operations are here in Louisville. The company was established in 1865, so we're starting our 155th year. And in 1865, we were mainly doing brewing ingredients, one of which was burnt sugars, which we sold for the ales and stouts at the time. My grandfather joined the company in 1896 when he was 16 years old, and he had a chance to purchase it in 1931. Since you all are into acquisitions, I'll ask the question, okay, in 1931, if you have a business that's based on the brewing industry and the country's in the middle of prohibition and you've just come through the Depression, why do you buy a business? My comment generally is because I think that that was a business he knew, he'd been involved for a long time, and he really cared about the associates. So anyway, Dad moved to Louisville in 1950 when he graduated from university to start our manufacturing plant here. He retired in 1992, and as Bill mentioned, I've been CEO since then. Today, we are the 2nd largest global manufacturer of natural and caramel colors. And it's been quite a transition. So what is that market? So the market is natural and caramel colors, or non-artificial colors. So we don't do any artificial colors. It's all natural or caramels. We would do about 60% of what we do is brown. So think Coke, think Scotch, think Irish. Don't think bourbon, unfortunately. But think soups, gravies, and things like that. But then also a wide range of natural colors. So cheddar cheese, we have a plant in Wisconsin that does about half of the cheddar cheese. We do a lot of McDonald's cheese, whether you like it or not, Velveeta, Kraft mac and cheese, things like that, and then a lot of salad dressings and whatnot. The total market is about $1.25 billion. But when we looked at it about 20 years ago, it was a lot of very regional single product companies. And one of the advantages that we knew is that we were a global company and we were already dealing with a lot of the global companies. So since 2005, the industry has now rolled up to 3 global players, of which, as I said, DDW is number 2. even the largest player isn't that interesting to multi-billion-dollar players because they're looking for billion-dollar industry. So it's a nice little niche that we can stay in, and obviously have done pretty well. And there are still lots of other ones. So here are our locations: 13 manufacturing locations, 8 countries, 5 continents, 2 in Asia, 3 in the U.S., 2 in South America, 1 in Southern Africa, and 5 in Europe. 340 associates, roughly 100 or 1,600 customers on 110 countries. So it's truly a global company. Each and every day, next slide, please. Each and every day, we color over 2 billion servings to consumers. So that's everything from Coke to soy sauce to whatever. Kevin, I'll apologize. Pernod Ricard is a good customer of ours, not quite as big as the Guinness part of Diageo, but when you talk about Jameson Irish whiskey or you talk about some of the Scotch whiskey, D.D. Williamson is privileged to have a 100% market share in the Scotch whiskey, particularly the blended market. So it's been good for us. But dealing with really all of the major customers in the food industry. Just to give you a sense of what we've done, this wasn't our first rodeo. As I look back in the history of the company, we actually did our first acquisition. My grandfather did, I guess, in 1918. Several in the 60s, 70s, but really started 20 years ago by looking at the market and saying, how can we roll up the market? With an acquisition in Manchester, getting into natural colors in 2004, 2005. You'll see DuPont #1. We actually bought a DuPont Colors operation that was doing cheese coloring in Wisconsin. That got us familiar with DuPont. They were getting out of the industry then. We built a colors facility in Ireland in 2014. We built a new plant in Malaysia in 2017, and then DuPont Colors #2, which is what I'll talk a little bit about today. And then just recently this year, we did a joint venture partnership with a fermentation company in France, and our focus there is on blue color. So blue natural colors from a fermentation process, which we're excited about. So DuPont Colors #2. In 2017, DuPont and Dow were merging together. In Europe, it had been determined that they had too high a market share in the pesticide business. So they sold off part of their pesticide business, and in exchange, they got a food business from FMC that included two facilities. One, Burton-on-Trent, which is not too far from Birmingham, England. We'd known them since 2007. We were pretty familiar with the operation. In 2012, they actually had a sale. FMC bought them for an awful lot of money. We were in the picture, but we knew the partners. I thought we might be the front runners, but we weren't anywhere close from a dollar standpoint. It wasn't a good fit with FMC. It wasn't global, and so basically it went into a maintenance mode for 5 or 6 years. It was less than 1% of their sales, so it really was very non-strategic to them. They also had bought a facility in Santiago, Chile. Again, pretty small, but once FMC realized that without being global, they really couldn't do much, it just kind of went into maintenance mode. As I said, it was acquired by DuPont in 2017, and we knew, again, it would be small to DuPont, it would be non-strategic, so we immediately advised DuPont of our interest in that facility. They went to an auction in November of 2018, and we completed the deal in June of 2019. So why did we want it? Why did we buy it? Next slide, please. First of all, it was regional, but it fit us to a T. It large market share in Europe, Southern South America, and Asia, all areas where we didn't necessarily have a large market share. Our large market share in natural colors at that point in time was in the U.S. and parts of South America, and we knew the business. I mean, it's been our business for many, many years. It's been since all my working life for 46 years. We knew the customers. We knew the geography. We felt like we knew what some of the possibilities were. As I said, the industry was consolidating, but it wasn't great for multi-billion-dollar owners. And this transaction particularly was not great for private equity money because you would have had to put together a sales team. The sales team didn't come with it. The HR team didn't come with it. The finance team didn't come in it because DuPont was going to keep them for their food industry, their nutritional business. So for us, we had a sales team, we had an HR team, we had a finance team. So it really, the fit was extremely good. So it made a ton of sense for us to do it. Timing was good. We had good cash on our balance sheet, and we had a great banking relationship. So how do we get it done? I've got a great, I said, in-house acquisition team. It's actually my CFO, my COO. The team is small, nimble, and we were able to move pretty quickly with DuPont. As I said, we knew the business, so that helped a bunch. And we had very good partners. Our legal group was K&L Gates. They've been doing our global legal work for a bunch of years out of London. And JP Morgan Chase are our banking partners, and they couldn't have been better in terms of supporting the deal for us. So we knew we had the financing, the background that we were going to require. Persistence and patience. As I said, we've been tracking this deal for the better part of 7 years. And even as you're going through the deal, we would find that we would be able to respond in 24 to 48 hours, and it'd be another 2 weeks before DuPont would get back to us. So my clue there is multinationals can be really slow, particularly when you get into their market. And quite frankly, we knew the business better than the seller because it was our business. They knew the food industry, but they really didn't know the color business. We understood the value. As I said, it wasn't a good standalone, so it was a poor P&E fit. And when we got to meet the local teams, they really liked our culture. We are obviously a family-held company. We believe a lot in continuous improvement. We believe a lot in the value of our associates and our customers, and we're totally focused on colors. So this really worked well. And in any deal, if you've been through it, you're going to have some surprises, plus or minus. I will say in this deal, most of our surprises have been plus ones, which has been great. And then finally, the integration and transition. I'm really glad that we weren't under COVID-19 when we went through that, because we could be on site. We could meet we could meet all the associates, and we could actually visit with the customers at that point in time. So it was a great transaction for us. The EBITDA multiple was probably somewhere between 6 to 8 on that one. It's hard to say because so it was a nice multiple. It fit us well. And if you look at our bottom line this year, we're up 37% over last year based on that acquisition. So it's been a great fit for us. So what's the future hold? I think we'll continue with the integration and I know we will of this transaction. We've already gone back and we've gotten some of the lost customers. They've got a number of great products. They're chlorophyll green. They're the largest and really only supplier of chlorophyll green, or we are now, from grass. Great vegetable black, plant-based protein, which you hear about all the time. So think veggie burgers, Impossible burgers. They had actually developed what we believe is the best plant-based protein color. And we're continuing to drive some of their products into the nutritional market as well. So we continue to innovate. As I said, we have a partnership with a company in France now. And we're continuing to look for opportunistic acquisitions. There are probably 2 or 3 on the radar screen. I'd probably wait until after COVID-19 till I can take advantage of them. But we believe that as the second largest manufacturer of natural and caramel colors, we're in a really good place to continue our growth and really, as I said, build the team and take it to the next level. So again, thank you to ACG for this honor. Much appreciated. And I'm not sure how well deserved it is, but we appreciate the recognition. Thanks so much.
To give people time to maybe post a question, I'll pose one to all of our finalists and award winners today. As ACG, there's a lot of focus on acquisition and growth. So I know you all highlighted this to various levels during your presentations, but may get an idea from each of you. What do strategies for further growth look like? Organic, or is it primarily through acquisition, and then, if it involves M&A, what would maybe a ideal target look like? Ted, I know you hit some of your growth strategy already. I'll start with you, but so since you already talked about it some of it, maybe what would an ideal M&A target look like for you all?
We're looking for strategic fits. So what's that mean? That means a color that maybe has a unique position in the market. As I said, we just did this partnership with a company in France that does a blue. That looks pretty good. There's actually another company over in Europe, which has a pretty interesting, we've known them for years, burnt sugar. It looks like they may be available. So really looking for those strategic fits, but as well, continuing to focus on internal development. I think we probably have the number one innovation scientist in the natural color industry on board. And Jason comes up with tons and tons of new ideas on a regular basis. And we've got a great team of scientists here in Louisville. So I think it's going to be a combination of both. Which I think it has to be.
Okay. And Kaveh, may pivot to you, pose kind of a similar question. I know you're working in conjunction with Pernod, but yeah, what does growth strategy look like for you all? A mix of organic, acquisition?
Yeah, I think, for us, right now we have a lot of ground to cover, right? So because we're such a young company, the main objective, particularly with this partnership with Pernod, is to be able to make sure that we get a reasonable market share within the U.S. And as I mentioned earlier, now looking and have our eyes on the international market. COVID naturally has been essentially a factor slowing things down, coupled with the tariffs. But we're pretty bullish about the future of bourbon and American whiskey. I feel that now that both nationally and beginning to internationally, people are getting a taste of bourbon. We have a pretty bright future. So our goal really is, and our focus for at least for the next 4 to 5 years, is to scale the business from a standpoint of rabbit hole itself. With that said, part of what is attractive to me in terms of partnership with Pernod is also to be able to bring Pernod to the fold when it comes to American whiskey. I don't know how many of you guys know, but they used to own Wild Turkey. They actually sold Wild Turkey in 2007, which was probably, in my opinion, one of the worst decisions they made at the time. But they did it for lots of good reasons, and part of it was to actually acquire Absolute. And now, in a sense, part of my guidance and advice to them has been to be able to, in some ways, catch up when it comes to American whiskey. So there is a pretty ambitious plan to be able to not only scale Rabbit Hole, but there was an acquisition of Jefferson's late last year, Castle Brands, and there's potentially more opportunities like that we're going to be essentially eyes and ears on the ground here in Louisville and in Kentucky to make sure Pernod is able to become really a significant player within the American whiskey category, like Diageo and a lot of the other big players.
Great. Thanks, Kaveh. And Dave, I'll pivot to you and pose a similar question. I know you all were recent targets of an acquisition, but now with maybe access to additional capital, what does growth strategy look like for you all?
Well, the reason that we sold the company from the original investors was that we needed to have additional capital that we just could not raise anymore from angels. And so we hired an investment banking firm, a company called Edgemont out of New York, specialists that work in medical specialties. And so we spent most of 2019 getting ready for the sales process. And then it was literally a year ago today almost that we closed the transaction. Now, the reason we did that was to get access to the growth. We are a people-intensive person or company. We depend on a ready supply of qualified radiologic technologists, of which there are many in Louisville. But for us to really grow beyond where we are, we have about 10% of the market right now as we define it. And there's nothing that we can see that would stop us from getting to a 40 or 50% over the next few years, which would be a huge, 5x kind of penetration of what we have. So our main reason for the main philosophy we have is we want more of the same. So therefore, we eventually will run out of rad techs here in Louisville. So we've been actively looking at and looking at and hiring people in different places. We probably will open an office in Indianapolis and another one in Nashville and probably Cincinnati. Really doesn't matter where our people are, because they can work with our technology anywhere. So that's one, and to continue to be aware of what's happening in the technology itself. Artificial intelligence is something that is becoming more and more prevalent. We are working with several different AI algorithmic producers so that we can use this. We don't want to be the people who develop the algorithms in artificial intelligence. We want to be a market channel for them. So with over 900 hospitals already, and the prospect of getting another couple of thousand over the next 3 or 4 years, we believe that we can become not only a distribution channel, but also make things more profitable through the use of artificial intelligence. Also, we can use this to get directly to the specialist and referring physicians, rather than being dominated by the radiology people that we work with. We can get from the radiologist into the actual surgeons and specialists a lot more easily, I think, with AI and other things like that. So we want more of the same, and we're going to integrate with what we do with some of the other acquisitions that Acumen and that Arsenal will, I'm sure, buy over the next several years.
Thanks, Dave. Ted, I had a question come in from John Sweeney, specific to competition in your industry. With it being a mature industry, as you mentioned, a pretty defined market, have there been any significant entries into the space the last years, decades?
I guess a couple of things. One, yes, the color industry is mature, but what we're seeing is a strong shift from artificial colors to natural colors. If you look at the industry, say 20 years ago, it was probably $900 million of artificial and $200 to $300 million of natural. Now it's about 600 or 700 to 400, and we see that continuing. So I think there's a lot of growth. And also within our business, like any business, you need to continue to innovate. Probably 80% of the formulas that we use across the company are new in the last 8 years. So, a lot of continued innovation to improve stability, to improve cost issues and whatnot. The entries have been interesting in that I think it's sort of been some of the larger multi-billion-dollar companies have gotten small parts of it because they made an acquisition. For instance, Givaudan, which is a, $5 billion flavor company, and they have a $50 million natural color company. Does it make sense? IF&F, again, another large flavor company, wind up with about a $25 million color company, and now they're merging with DuPont, so now maybe we'll have DuPont number 3. But, I think that again, because of the size of the business, yes, it's mature, but people are continuing to look for other alternatives. How can we improve this? How can we have a higher color strength of this green? How can we make sure that this green is stable in an acid beverage? How can we make sure that this red will survive heat? So, there's just a lot of different, because you're working with natural colors. So we see still a lot of growth opportunities, but I think it's important to be positioned globally like we are. As I said, there are only 3 of us there right now, so we're pretty excited about that.
And I guess as we were chatting, another question came in that I'll kick to you as well, Ted. It's from Duffy Baker at JP Morgan. Just talking about the issue of cultural alignment and acquisitions. As you're bringing people together, from industries, different markets, different continents. How do you maintain culture?
Yeah, well, I have to give a little shout out to Mr. Baker. Duffy is our banker at JP Morgan Chase. So Duffy, thanks for doing that for us. We appreciate it, doing the deal. Yeah, as I said, cultural alignment it's important. And I'm a people person. So, it's getting there, it's knowing the people, it's listening to them, understanding, what their needs are. Our business is largely dependent on raw materials, but people are everything. So, and understanding different geographies. We operate in Brazil, in Chile, in China, in Malaysia, and it's a fantastic diversity of people, all of whom have lots of great stuff to contribute. I believe in a lot of diversity. My CFO is a lady. My COO is a lady. It's okay. I can take direction from women. That works really well. But so it's a great diverse team that has worked together, and I think that helps us work across geographies because we can understand differences, which is a real plus.
Right. At this point, we'll pivot quickly and we ask people stay around as part of moving to virtual environment. We're looking for better ways to not only offer programming, but offer ways to build and maintain relationships in a virtual environment. So as I mentioned, I'll send a little more info for our following month. Middle Ground Capital will be joining us. They are a private equity group that is headquartered in Lexington and started in the last couple of years. Have just finished raising their first fund and have been acquisitive with about 6 portfolio acquisitions the last couple of years. So looking forward to John Stewart and his team.